everybody, and welcome to the Blind Ambition with Jack Kelly. It's your friend Rick from Blind, and we are excited to have Eugene Zhang with us on the show. For those that don't know, Eugene is the founding partner at TSVC, a venture capital firm. TSVC has invested in over 200 startups in the past 11 years, has about 10 unicorns under their belt. And Eugene, most notably, you might know his investments if you're in the startup space. Carta, Zoom, were all founded by Eugene as an angel investor. So a pretty impressive track record. So we're lucky to have you on the show, Eugene.
Hey, thank you, Jack and Rick. Thank you for having me. Yeah.
Our pleasure.
So,
I'm sorry. Go ahead, Rick.
No, I just want to get started. I mean, you have such a great track record. Like, where did that magic come from? How did you get involved in venture capital?
All right. So it's the start really by now, 31 years ago. I was just an engineer.
You're like 6 years old then, right?
Thank you. Yeah. So you know, our generation, I kind of belong to the new generation immigrant, right? That's during the high school, elementary, we got a little bit open up. So with this American dream, a melting pot kind of thing, this America. So that has kind of drove me immigrant here, along with a lot of that generation of immigrant. You know, usually we went to a university here in the States, and then we stay here, kind of find a job. So that I was that kind of a crowd. So very different from today's generation, younger people, but that's us. So at day one was really, find a job, and then I landed here, January '91. So I started my kind of career in Silicon Valley. So I had two paths. One was working with the big company in the Valley, and then second was the one that ventured into being a part of the startup. That's the kind of two paths. On the working for big companies track, was extremely lucky. Met a lot of nice and talented people. So work at first job was MDAW. Later on was acquired by Fujitsu, that's a Japanese company in the mainframe space. And then got a taste of what gets disrupted. Their business was disrupted by Sun Microsystem, for example. And then I joined the Sun Microsystem, 93. Those, of course, we occupy today's Meta or Facebook campus in Menlo Park. That was the glory days of Sun Microsystem. And
that was what Scott McNeely, right? Was that the guy's name?
That's exactly true.
Because they were huge back then, right? It's like
huge, yeah.
Shows how the names change. Like that was like the big brand name at the time.
Totally, Scott McNeely. We have this religious war with Microsoft at that time. There were the Richard and Redmond was the evil empire, right? In the Solaris, Linux, Windows, those are the days. So very, kind of. But the Sun has such open culture, unbelievable. I don't think any company today is close to it. So when I worked there, I also ventured into the startup. That's just so amazing, right? So myself and a coworker, he's an immigrant from Japan. And we work on a tool to help us, our job, but it become a product, become a tool. And with some Microsystem endorsement, and we introduced a vendor to sell our development into other companies, not only to Sun. So all kind of with the Sun Microsystem endorsement, it's like a side gig, is endorsed, and Sun become the customer, and all that. And then we started this, and that project later on become quite important in the hardware design space. called a system Verilog, a kind of language, and later on acquired by Synopsys, one day for $68 million. That was the early days. Okay, was the fire, right? It's like, okay, so you want to realize the American dream, you don't have to be just working for big companies, right? That's the Silicon Valley was about. That was the but let me quickly and then finish. So then I move on to Cisco system, because my kind of a coworker took me there. So that's why very important, for the young people, never kind of burn the bridge. So I got to Cisco. At that time, Cisco stock doubles every 6 months. Sun was probably already a great company, but Cisco was the new star. So we all went there because my coworker took me there. And after a year and a half, it was amazing run. Cisco was a very, we have the happy hour, beer, bars, whatever, all that stuff. Company doing extremely well. Then someone knocked on my door and say, hey, we are starting Juniper Networks, right? So the best team in the world, hardware from Sun Microsystems, the best software engineer from Cisco system. We are gonna be the new star. So I got brainwashed to quit and join. That was such a lucky move, because my boss at the Sun Microsystems was one of the co-founder of the Juniper. So that was unbelievable. 3 years, went public. Market cap was as high as $70 billion, in 3 years. So I worked there for about 6.5 years, 70 billion. So for a lot of, and so kind of we all got into a financial freedom states. That's kind of the, well, previously the company sold, but we got a cut of it, but it was not a, we were not the founder. We were developer, but it's not a fund, like today's structure. So anyway, so that enabled me to start an investor. So friends and all that knock on the door, hey, you give me $10,000, you give me $25,000. So I started the angel investment after 2000. Of course, the crash, all that stuff, very important when to sell your stock. Lesson learned, right? It's so crazy. Because, okay, so here's the thing. Juniper was $220, and then all the way went to $5.
Ouch.
So yeah, 200 to 5. So that was the ride. So then later on, it's kind of funny just talking about with the other engineers, hey, how many shares you have, all that stuff, but it doesn't really matter. The matter was when did you sell? It's kind of that message was meaningless, right? Until 2022, this year, right? In
it's happening again, right?
It's the same
we're
thing.
Seeing it repeating, sort of.
It's just the repeating. Yeah.
Wow.
So it's so many companies right now with like 1/10 or 5% of the shares, right? Look at all the Nasdaq, so many of them, right? It kind of similar. So okay, anyway, so I started, and back to your question.
Wait, can I interject for a second here before I lose my train of thought? So to unpack this, Rick, you probably noticed this as well. It's so interesting because I see so many commonality between successful entrepreneurs. One is you picked up and just left your country to come to a new country, which in my opinion, because I was born here, I was a second generation, so we weren't here that long, but it's risky. That's like a scary thing to do. You say it like it's so easy, but it's hard to pick up, leave your family, your friends, everyone behind and come and have the courage to do that. But then it seems another thread I notice, and Rick, you probably see this too, is that you have to be in the right place at the right time. And I think for a career, with Silicon Valley, it's being in the right place at the right time because you have the right skill sets and you have the engineering background. So like it all comes together. And then you had the courage to kind of change jobs and build out your network and grow your network so that it enables you to have other, successful endeavors. So it's so interesting. You're saying it casual, but to the outside observer, it's like amazing. It's like a playbook of how to maybe make a successful career for yourself. Does that make
so,
sense?
Yeah, so a lot of people are, I know, far more, by the Silicon Valley standard, far more ahead of successful. But kind of a few takeaway was, I 91, I landed here was after I submitted 300 job, application, right? Because that was the recession, Cold War finish, right? There's nobody. Everybody told me, there's no jobs in the market. There's absolutely no jobs openings. So you hide as a RATA behind the professor. That's the only place to go because nobody's hiring. I just was kind of brave enough, after 300 job application letters, I landed here. That was just amazing. Single, just by myself, single at that time. Yeah. Other things I think, that means you need to do more than other people. That's the one for everyone. And then second is, is a small world. So I lucky get to some ecosystem with a star company then, and then Cisco and Juniper was one after another. Was really a lucky kind of sequence. And then all because of my coworkers, and then they just never burn the bridge, right? So you always run into them. You try to let other people willing to help you, right? That's kind of the thing, very important. So that's it. That's about it.
To fast forward, when you start investing in startups, is like, let's take the biggest one. Let's say or I don't know if it is the biggest one for you, but with Zoom, that has to be an amazing feeling that you're involved at the early stages of such an iconic brand. That's like a household name. It's like Kleenex. It's like, Xerox, whatever it's become. Zoom transcends just videos. It's it kind of defines the whole category. Okay. How does it feel? Just out of curiosity, like, how does it feel to be the guy who wrote that check when no one else wanted to write that check, and then you sort of succeed?
Yeah, so of course, Jack, I have to say that this is all the afterwards, the thinking. Okay, so let me kind of provide the background. So after that, the 2000, I started to be the angel investor, started learning. But of course, the investing only in friends or that's just like a very, very typical or other people made it what they do. And then, I have some luck also as an angel investor. And then I joined a fund to learn. Actually, I didn't know about the investment side. But but I joined a fund, but attending these seminars, the VC pronounce say, here's how to VC. VC was such a kind of a prestigious kind of, right, like a job, right? So I remember there's one day, there's a VC was making, as a keynote speaker, and then someone in the audience say, hey, I love this job. How can I be a VC also? Well, what I remember was just the answer was because it's such a chicken egg thing. So it's virtually impossible. It's that job path is not open. Okay, basically, I got is it's not open because you need to build a track record, all that stuff, and you need to know the business and the finance and all that stuff. So the path is not open for engineers to even think about it. That was the answer. Okay, that many years ago. So also the table was very different when I started my company after Juniper. I started my company, 2003, right? It was a very difficult time to raise money. The liquidation preference, if for those who know, it was by Fenwick and West, with the standard return was 3x. Unheard of, right? Today, if today someone mentioned it's going to be the vicious, like shocks, right? 3x liquidation preference. So that was the standard term from Fenwick at that time. I remember so clearly.
Wait, Fenwick, is that an account? That's a law firm?
Oh, okay. So it's a West Coast a law firm,
right?
Quite sizable here, but I think mostly in the West Coast. Fenwick and West is quite famous. I think they are the bigger client, Cisco system, all that stuff, among other ones. Yeah, quite a big law firm. So the law firm give you the standard term sheet. and then it's written as like a 3x. So that's
3x.
2003. Yeah, 2003. Yeah. So that was the time. So money very hard to come by, all that. So get back to your question. After then I joined another venture fund, and then I co-founded with another my schoolmates. So that was 2010 with the alumni friends. So everybody had some success rising to a level of a corporate. So everybody has some money. So we formed this the fund. That was 2010, and then our fund one was lucky. We wrote a $250K check in Zoom. So that's July 2011. So after a few years, I practiced my angel. That's still learning to invest, but that was kind of the timing on Zoom. Yeah, it's July 2011. Yeah.
So I'm sorry, Rich.
I mean, how much did that 250K check return?
Okay, so that is a tough question. So we only talk because our cost is fixed. So we were 11 cents. So then you see the stock wherever at one point was 550 or almost $600. That's the okay. So that's another thing. Okay, so
all right, wait. How do Rick and I get into venture capital? That's I think this is the takeaway, Rick.
How do I get how do I attach my cart to Eugene's horse?
Yeah. Are you guys hiring VCs?
Yeah. Yeah. So I think you are fine doing this per program. But anyway, so that I want to quickly talk about that. There's at that time the pioneer. I want to quickly talk about the sector, right? So the pioneer was a WebEx. Eric who came out of WebEx was the pioneer of creating this sector, video remote conference, right? Before that was the meeting was just personal, right? So there's no such a thing, remote meeting. It's just not. It's so anti-culture, right? But until WebEx was the pioneer, and then Eric worked there, hiring over directly from China, and then WebEx didn't take off until 9/11 when the people feel flying is no longer safe. Then that other stock all crashed. The WebEx took off, right? Become a mainstream product because people say, finally, okay, I can have meeting remotely. So, but later on, WebEx was sold to, of course, Cisco System for $3.4 billion, and then Eric was part of it. And then he had this idea of building the next generation, optimize on mobile, all that. That's kind of the story. The first round was all angel investors. We were the only little fund in it. Yeah, so right now, so far we have, quite lucky with 9 unicorns, including Kala, Iterable, quite a few other ones, Ginkgo Bioworks, quite a few other ones in various sectors. And yeah, so that's kind of the.
So that's interesting because how do you, sometimes I see with certain VC firms, they'll focus on one vertical, but you've succeeded in biotech, and I think one is AI type of driving. So all different is there a common denominator, or you just have to learn, or you have different partners who specialize in different things?
Yeah, that's a very great question. So we started with the kind of the firm, the roots. We always had, when I started 2010, right? So it's a very small fund. It's only like $4 million. Nobody get paid. So if anybody at that time, we start a fund, it's working on weekends, all that. I was a part-time also. So if anybody treat it as a job, the fund will not exist. So, and then we end up with 2 of us. We have a total of 10 people being on the investment side, right? The partners. but we end up with two of us. We sign up, take on the liability, become the GP until today. That kind of how we got started. So you know, the being sign up as the general partner, take on the liability also along with it. But day one, we have this very multiple domain expert. You know, we rely on, you know, day one, it's not like a 2 people, but it's always like a 10, 12, and everybody cover, and we're recruiting new guys. They bring in, you know, day one, we were more hardware focused guys, right? The semiconductor. One way or another, later on, we have the software people. So then we kind of culturally, we have this software hardware, you know, the additional team member. So in general, at the high level, we are a generalist, you know, technology, seed stage fund cover. We try to cover all the emerging technologies and with commercial value within, you know, 5-10 years. That's why we always, that also make it fun, you know, Jack, you think about that. If we stay at a juniper, like at the telecom, it's gonna be boring, right? It's like, do you see a big company emerging in that space? Like, you know, networking, you know, it's not. So we always try to follow our expertise along with the new emerging technologies. We never, you know, kind of, we will need to be dynamic, basically. So that's kind of the firm culture. And we always have, today we have a strong 12 venture partners. They are founders of all sectors, various sectors. We have a GP team and sectors. That's how we, from day one, we form the fund. So we are able to cover a lot of areas that a typical fund of our size cannot do usually.
And it sounds kind of risky in the sense that early stage investing seems to be risky to begin with. But then if you're going out on a limb on more tech, you know, but kind of new tech kind of stuff. So I guess you guys are not afraid of taking these big risks for big gains, huh?
Yeah, so this is the interesting part. So we recently also did a lot of analysis of the risk. So that's why we also have a fund. You know, you have, like, say, $10 million or, you know, 50 million, but if you put it into one company, that is absolutely high risk, okay? But that's why we, as a fund, we have a portfolio construction. You know, we also fine tune our model with the portfolio, a certain number of portfolios. So with that, actually, it's very interesting in this volatile market. You know, each of investment is high risk for sure, but putting them together based on our, you know, whatever ways we make decisions, actually its risk is quite actually low compared with late stage. For example, the growth stage, this year or last year, you know, we even have a valuation increase across quite a few of our funds during this year. Then a lot of unbelievable write down, for example, right? So from that angle, you know, with the portfolio, you know, construction, you know, the combined risk actually, it's not necessarily high, you know, at the C stage. Yeah.
I want to dig in there in terms of portfolio construction, because, you know, the common assumption is, you know, like late stage venture capitalists, they have it fairly easy, right? They write bigger checks, they write fewer checks. They're working with companies that are known quantities. Oftentimes they are, you know, series B, C, D. They have product market fit, right? They have huge teams. Oftentimes these VCs are working with dedicated CFOs and like teams of finance people, right? That can model, and, you know, it's quite sophisticated. But you're mentioning, hey, actually, there's still like quite a bit of risk in these late stage companies. And in some cases, they might be more risky than the investments that you're writing out on the seed or early stage. Why is that?
Yeah. Okay. So I think that's great question. I think for the things you mentioned, they are also true. You have a very data-driven model, all that, right?
Sure.
But we also we zoom out. We look at this period, the last say 13 years. We have this. It's right now we are in transition, or we are already transition to different phase. But just until 2021, this is the window that that a strategy, for example, late stage look at it, and then especially with the public market support, just roughly say 13 years, there are macro cycle in it, but this is a very unique bull market run, and the pattern you can repeat, because you do the data analysis, for example, the SaaS companies, right? That's why, until last year, they command such high premium, right? So from, in the old days, Cisco days, 10x the revenue, that's not a SaaS at that moment, or ARR year. Just 10x the sales is the sky high limit in terms of valuation. When the company is not profitable, I pay 10x the sale. That's the highest price. Cisco did so many. And then you fast forward to 2020, 2021, you see so many companies get public traded at a 35, 40, or even way high multiples. It's because it's so well understood, or that then people willing to pay. It's a beautiful business model, right? But people are paying higher price. So that the model you have was beautiful, making a lot of money and very safe, less risky, because you see the public market, then you value at it. Today you value it as 30, and then the public market is trading at a 40. Then you are guaranteed, making money, all that stuff, until the whole thing changes, right? So right now you are late, it's all right now we don't even know the public market where they are, and then you pricing a $1 billion company become extremely difficult, risky, right? So you in 3 months you will know that maybe you are 50% overpriced, and because of the bigger dollar amount, that is so I will really say, last year, if a lot of people deploy capital 2021 in late stage, that is in really, really bigger hole right now. Right. Yeah. So that's why I want to say, going forward, even no matter the downturn is 1 year or 2 years, our C stage, because the long-term orientation, actually it's could be the better time window to deploy, and versus the late stage, you really very hard to deploy capital right now, right? That's another thing. Yeah, for us that risk profile, because we company usually also in the downturn, and then so the valuation at this stage we are not in the norm and not like a late stage.
Got it.
Eugene, I'm curious about this. When you saw before the show, we talked a little bit just about FTX, and I know we try to keep it evergreen, but the point I wanted to bring up is when you saw the investors in FTX, it was almost like a who's who list of top VCs and top money managers. And I don't want to call anyone out, that's not my thing, but is there something that goes on in Silicon Valley where it's this FOMO thing, where you have this group think that if Rick is going to be involved and write a check, and Eugene is writing a check, and so forth, then I'm going to write it because I don't want to be left out, because this could be the next best thing, and I'm going to miss out on the next Uber. Is that a common occurrence?
Yeah, I think the VC, typically driven, typically like a typical investors, the two why, the fear and then the greed. Okay, so for a long time, until especially the last, say 3 or 5 years, right? It's a fear of missing out was really driven. The VC must have the courage, right? So if you are a brand, whatever, we all know a few names, usually we don't know the performance now, and then you're missing out on a bigger hit, right? A big kind of brand name, you looks bad. So So for example, Sequoia always on their website, I remember I studied their website always, and the message is, I don't care about, what do you do, what sector, what industry, but I just simply, very simple, I have the world's greatest entrepreneurs. So they always come to me, that's it. I don't care what you do, but I got the best, right? But anyway, answer your question.
So is that a thing, by the way? So that's a thing where you could be, because that's what they were talking with that guy, Sam Bankman-Fried, that he went to Sequoia, and there was an article in the Financial Times where some of these junior VCs were gushing over him. He's playing League of Legends, on his side, and they're just saying, "Oh my God, this is the best person ever," and they just, everyone threw money at him.
Yeah. So this is, I think this particular deal, right now, I tend to think it's a little quite a bigger things at stake, a little bit beyond FTX, right, at play. Certainly, you give someone a lot of things. It's that you do the basic. I don't believe nobody at Sequoia look at the financials, all that stuff. No, usually that's the basic stuff. It just the decision finally was try to not look at it. So all say this is not important enough, right? There's other things to override.
Well, does it happen that if you see all these big names, like let's say I was a VC and I see all these big names putting money in, I'm going to think, well, they must have done their due diligence, and I'll piggyback on their due diligence because they're smarter than I am. And then you get that pile-on effect. Yeah. And then you wake up and said, oh my God, no one really did their due diligence because we all thought everyone else was doing the due diligence, and it's a mess.
Well, so certain, I think, you are right, but maybe also Sequoia is a separate thing. A lot of VC here, investors say follow certain. We are very proud. We do the deep tech. We have the expertise to do the independent due diligence. So we always make it 100% and our own decisions. But many fund prefer rely on certain names. It's their kind of they can spend to have other people do the DD. Help them. Sometimes you get lucky. So works out. For this particular case, I think it's more like there are other factors into this. Maybe the money, maybe so obvious you will make a lot of money. If you are not in, you will look like a fool. So it's some other things override the DD checklist. I think they did this. I bet, I didn't know for a fact, but for being a bigger fund, they did a DD, but there's definitely some warning signals, but the final decision was to overlook. That's my guess.
I would imagine
DD, for those that haven't followed along, it's due diligence, right? It's the
due
process
diligence
in terms of like examining the business model, looking to see who's in the leadership and who's on staff, making sure things check out, right, as part of the investment process.
So when they later, but usually even our state company, when they generate revenue, without a general revenue, early stage, you will need to have a plan for called a user proceed, how you spend money. We need to manage you or how long you run, right? At least you have a plan. In 3 months or 6 months, we need to measure you against that, right? That's very simple, right? Otherwise, you have started, we don't know, you say you are doing well, we don't know how, right? So you have to, so then of course, you have a product development, all that, but how do you use the money? Also, a new CEO learning on the job, need to manage, very important, manage the cash flow. But if you have a customer, paid customer, then we need to quickly dive into the financials, right? You have to testing the CEO. So those are the things that just like all the publicly disclosed, right? FTX, the financial statements was such a non-financial statement, right? Even though if for us to look at it, it's like laughable. It's for anybody to look at it, it's not a financial statement. It's a whole bunch of hits. So it's very hard to believe investors will overlook this. Okay, they didn't look, they'll look, but they finally decide to downplay. So
Now, this might be a silly question. Don't laugh at this, but it seems from the outside, as a VC, and you have your portfolio companies, they're like your babies, like your kids, where you're nurturing them, you're helping them grow. Are there any, and I know you don't want to play favorites because like with kids, you don't want to say, oh, my favorite is this or that. Are there any companies that you have now that you'd like to share with people, just that maybe they're not aware of, but they're really cool and they have the potential to break out? Would you,
Yeah.
anyone
Yeah.
you'd like to share and talk about?
Yeah, sure. Sure. We have a lot of favorite kids, but I think I want to mention one. So earlier you mentioned our, you know, we have a quite diversified kind of technology. You know, some software, hardware. Right now we have part of a company in the robotics space, right? So you know, robotics space. You know, we are very focusing on certain verticals that in this environment or in an even future environment or in this even cycle, very important to generate positive unit economics, right? You cannot have build a very high-end advanced robotics, you know, doing cooking pizza, right? You know, because that sounds all good, but there's no money made, right? It could good on video, good on PR, but it's that kind of thing. So for example, one of the company we invest in called eBots by a seasoned entrepreneur. You know, the company's high level vision is look at you know, 40 million like a mostly female kind of 3-shift workers in Asia working on electronics assembly, especially the smartphone assembly, right? So they are working on 3 shifts, and then their job sitting on the bench 8 hours is to move, maybe take a cable and using eye-hand coordinations to plug into a socket. For example, you open up our smartphone, a lot of wires, all that stuff, right? All that little socket, all that stuff, it's all handled by human. 3 shifts. These work usually young female workers can only stay on this kind of job for 3 years, and then their eyes get worn out, and they have to move away for a different job. And the company hiring new people, train, and then replacing. So that is, you know, we heard a certain, you know, effect on like a China factories, Apple factory, all that. It's kind of the part of the problem. So this is a huge, you know, kind of, you know, the need there. Not only kind of generating, not only provide lower cost, but also replace certain jobs not good for human. So we're very bullish about this company, you know, going forward. So that's just one example. Yeah.
That's a really interesting one. I can see that scaling up huge because there's so many sectors that rely on that, and then just it's almost kind of going back in time. You know, during the Industrial Revolution, where you're just doing all this by hand, and you need, you know, more technology. Any other really cool ones? Because I think that Rick, right? That's pretty neat, huh?
Yeah. So another thing I was thinking is we are kind of immigrant, but many years American. So we have this on people onshore or made in America, such a lot of manufacturing, right? But I personally, being a tech person, you know, I don't believe it translates into the jobs like in all the way, right? Because here in this country, we are more developed. It just has high costs. It's inherent. You cannot, if this is all done the same way, literally moving one job from Asia to America, you have high wages, you know, but by definition, it's not a cost competitive, right? So it's, I believe it's a new format. The new format is combined with automation play a role, right? So maybe in the, say just using a number, originally maybe 100 jobs, but now you net increase maybe 20, the other 80 is by automation in that format. So with the cost very competitive, then you can be, compete in the global market. That way, I see. So another company, I
Wait,
think.
can I just interject? Something like that. Do you bring up, or people on your team, to kind of someone in the Biden administration? Because that's a great point. No, sir, I'm being serious. Like, because that's a really interesting point you're making. So that we're trying, whether it's a Democrat or Republican, they're always trying to say, hey, let's bring jobs back to the US, particularly manufacturing jobs. And so what you're saying is that if we could kind of manufacture, but not old school manufacturing, but the way you're talking about, that would be something I would imagine they would embrace and say, hey, this is what we need. Does that get done, or it doesn't work that way?
I think many the work will be done by a private sector. I already sense already.
Oh, right. Definitely private sector, but having the federal government giving some support.
Right. So that some private sector happen, and then maybe someday propagate to a politician.
Yeah.
Okay, but that's entrepreneur. That's why when you have this, of course, we have the de-globalization as the big picture. In this environment, entrepreneur always, they want to be creative, and then also they need to compete, and with being sustainable, right? Just high cost structure doesn't. You rely on government subsidies, it's not going to go far. So the entrepreneur, we figure that out. So I think the market force we have, we have a company, in the warehouse. They are also gonna getting some warehouse robotics. Another company I kind of mentioned also in the right now, happen to be in the robotics is the also addressing labor shortage. The first application is the vineyard. Okay, so all the grapes, making wines. Okay, what I learned is every year you need to prune them, and you need to cut so you have a tea, and then you need to cut the ones that are the next to the main trunk, whatever. You need to prune them every year and grow new ones, and then and then have the grapes. So that's a must-have. And then for human, if you have 1,000 acres using human to do it, right, was really so it's kind of the automation on the low-hanging fruit side, right? We back a company, they are day one generate revenue, very good traction with farmers, because the farmers, they have a limited profit margin, all that stuff, right? So instead of very hard to find this California during those time, very hard to find labor, right? Very cost increasing. Instead of hiring 80, they can hire maybe 40, or maybe 30, so let the machine do the pruning and for them. So and then this it's also a robotic and computer vision kind of thing, and potentially the technology can apply to Europe or the vineyard, for example, and apply other products. So that's another one, solving the labor shortage problems. Yeah.
I think I also saw on your site that there's some AI for autonomous driving. Is that?
Yeah. So another one also today, autonomous driving was kind of hard for a long time. Our company called Plus AI, they were focusing on very quickly. They zoom in on the truck, long haul trucking. That's very difficult to kind of sometimes truck, you have the limit how many hours they can drive, otherwise so dangerous, right? They fall asleep, all that stuff. So that's really among all the autonomous driving space, I believe that is the first one, kind of will relatively simpler than city, right? This is more highway, and then so that's one of the company that very quickly went to a particular vertical. They are deployed at a, right today at some scale, and then hopefully they can scale very quickly.
You know what? We should introduce you to somebody. Rick, can you recall the guy's name who has a startup that was that had software for all these truckers, like a huge amount of. Do you recall?
Yeah, the company was Transfix, so it focused on freight and logistics, and
Oh, okay.
it was primarily concerned with figuring out how to make what's like, I didn't know this, but trucking apparently is a very like paper and manually intensive work, which is insane because it's, the backbone of everything, right? Everything that I'm looking around in my room right now has probably gotten to me on a truck in one way or another.
Yeah.
And his point was, yeah, no, that's exactly it. And he created the kind of software solution for that, Transfix,
Yeah.
which was a really interesting kind of company to look into.
Yeah, they're going
Okay,
to do a
yes.
SPAC. I'm not sure what happened because SPACs kind of got out of favor. So I
Right.
don't know how that played out. But yeah, if you afterward we could send over his info
That's
because
great. That'd be great. Yeah.
because it sounds like a great way to kind of. And he's a really nice guy. So this
Okay.
see if I forgot how many trucks, but it was really he has some reach.
Yeah.
Yeah.
It was,
Definitely.
Jonathan Salomon.
So look at this. We're doing deals.
Okay, sounds great. Yeah.
Like Rick, we're doing
and
deals
Rick.
already. See, look,
Yeah.
we're spending
We're his
20
scouts.
minutes, half an hour
Yeah.
with Eugene, and already like
Yeah,
we're
like
becoming deal makers.
opportunity always, or a partnership always, from all angles. Yeah. That's what I believe. Yeah.
I mean, so Eugene, your background is in deep technology, a lot of kind of industries that I think a lot of venture capitalists or investors, they don't touch because they don't necessarily have the technical expertise, right? They couldn't even start to understand the trends or, God forbid, do the due diligence. And I think this is a rare opportunity within deep tech. Are there certain industries or verticals that you're excited for going into 2023 and the future ahead?
Yeah. So let me quickly kind of comment also.
Please.
For using example, for example, semiconductor industry, right? So when I was at the Cisco and Juniper days, basically in the 90s, the semiconductor was very, very hot. But also it's also need a capital. It's not like a software company. They typically need more capital than a software company. Because they needed to do the, TSMC tape out, every tape out, creating this samples of the chip takes $1 million, that's why they need the capital. So then fast forward to, 2005, 2004, and a lot of VC on their website say, hey, I don't even look at the semiconductor deals because the return on investment, it's no longer there, right? Because during the 90s, a chip company, they can easily sell, just simply a few $100 million easily. But later on, you're burning 50 million, 100 million, you get a 100 million back, and nobody want to invest. That's for a while until the AI chip coming back, then it's a lot of VC, maybe just 4 or 5 or around that time, years ago. So that's the. But also at the big picture, last few years, because of the money policy, right? Federal Reserve, all that, the liquidity in the system, the high price, right? So all the good companies, the stock are very high because a lot of fueled by the easy, low interest rate environment, right? All that. So, and then especially the fintech. So when people can make money on fintech, 2 years, or 3 years become unicorn, why you want to invest in deep tech takes much longer, right? That's also true. So it's not going to be very popular. Just look at the 2000 or 2001, every year popping up, over 300 unicorns, right? Every single year. In other words, and I don't know the status of these companies. I bet a majority will not kind of go through the survive through the downturn. So that basically,
Right.
I think the easy money, of course, all investors want to make money quicker and relatively faster and easier, right? The hardware piece, the ones we focusing on, typically takes the more money and longer, right? But right now we are in a new cycle. So the easy money, quick money, the path kind of in certain fintech sector, for example, no longer exist. So yeah, so we are we are in the back, and so for what do we do? That's a lot of also funds we're coming to the deep tech investor, which investment which generating kind of compelling value, in this tangible value in this space, right? So that's kind of the very positive in general for the deep tech kind of investment. For example, for the example I mentioned, eBall and Beagle. So that's kind of the big picture. It's going to be promising and with creating really tangible value. Addressing pain points. All the traditional ways. Tanks better or tanks cheaper at least, for a company in this space to compare with the existing solutions. That's kind of the value creation, behind the reason, for the value creation, for example.
Got it. I appreciate all of your insights, Eugene. I certainly learned a lot in terms of kind of the psyche of an investor, kind of the difference between early stage and kind of the late stage, or kind of the blockbuster fundraising rounds that we've kind of see in the news headlines. And I really appreciate you putting that all into context for us and our audience. Thanks for coming on the show, Eugene.
Yeah, it's a pleasure to chat. Just to follow up on early, the things you summarized.
Right.
So the last few years was really a little special. So if you can make money in 2 or 3 years, why you bother a little longer, right? So and then all that, the easy sector, a lot of people, especially we say, for example, I pick a sector, SaaS, right? So a lot of late stage investors say, hey, Eugene, give me a SaaS company, and all that. So the minute that you hear 5, 10 people asking that, that a SaaS company, like a Salesforce, a lot of VC, when they created, SaaS was not the mainstream at all. It's a new thing. And a lot of VC didn't understand it and then decided to walk away. But fast forward to 2021, that's the most well understood business. Everybody want to get in. That's why the valuation gone so high, all that stuff. It's all over investing, right? That's the sector over investing. And then next year will be a lot of consolidation in the space. A lot of nice to have companies. So we are back to we need to look at the painkiller type of application technology breakthrough. So another company I didn't get time to talk is they can help test the cancer drug effectiveness, with 100x the speed, right? So think about the drug discovery, taking so long. Patient try, because they try the drug, with all the conditions, all that. One of the company we invest in, it's a hardware company, but helping the drug company to test the effectiveness at a much high throughput. They have a special device that help, helping this, so then the drug in the future, drug discovery for process can be shortened, right? For example, so that kind of thing all can be measured very if it works, it's very easy to quantify, measure the value. That's we love. Yeah. We
sounds
love.
Great.
Yeah.
Well, what's the name of the company, Eugene?
Oh, it's called Seldom, CELLDOM. Yeah.
So wow, you have a really interesting portfolio of companies. right?
Yeah,
I mean, each one, like I'm hearing like, wow, this is cool. This is, this is a game changer.
yeah. I want to show another one. We have the AI material replacing iridium to do the green hydrogen generation company also. It's a clean.
Well,
We are so all this is enabled by our part-time. We have quite a few PhDs. We cover material science. Material science usually have one application is today, of course, the battery sector, right? So we also invest in that space. Very different from many years ago. Very, very hard to invest in the past, but now there's a path. And then another application, material science could be, generating this hydrogen, catalyst. It's a material, but it's with multiple applications. So material science, chemistry, all has a lot of new things popping up with value creation, applications. So all this is enabled by our deep kind of we were able to assess the technology independently. Otherwise, if we don't know it, nobody, we cannot invest. So that's kind of we've been the one area we cover also.
It's great because, it's also helpful too, because Rick, I'd imagine there's a lot of people who maybe, work at Meta and these big tech companies who have seen their stock their holdings go down and starting to worry with about, I don't know how your layoff tracker is, like it's 150,000 tech workers who are downsized in 2022.
Right.
So maybe the move going to 2023, Eugene, is kind of looking at the companies, that you're representing, the ones that are a little different. They're not the big tech, nor are they the 10th productivity tool board, that's out there. And maybe for them to kind of pivot, for people to kind of maybe take a look and say, hey, I could pivot and I don't have to be in Amazon or Netflix or Google. Maybe I could kind of find a really cool startup with some really smart VCs who know what they're doing. And I could even maybe have a better career and then maybe go on the path like you did, Eugene, and then they could go on the path of starting their own companies and building companies.
Yeah, that's a great thought. I think at a high level, if we go through the downturn, again in Silicon Valley every time, and then new company emerge, right? So the Facebook and Google many years ago, and then quite a few new companies, Snowflake, the new types of company emerge. So with this downturn, I think the history will repeat itself. It's not like the old king will continue to be the old king, right? It's gonna be boring, right? Sun microsystem phase out, right. But such a talent kind of training ground, right? Like with the Google, we do look at the proliferation, right? In all the talent, when all the great companies, right? So it just does not make sense, I think, for Apple to be $5 trillion. Okay, so that's why it's interesting with the downturn, and then some new company maybe maybe today it's already formed or will be formed in the next 2 or 3 years, maybe creating a new disruptive force or creating a new sector, emerging sector, and then maybe a few years down the road we realize, wow, there's another. That's kind of the keep us going, right? So it's as a seed investor, because our investor, we don't see the money typically, in most cases, many years later, right? So that's keep us kind of going. Some company will be very successful, and we are part of it.
So that's actually a good positive message, right? To kind of maybe wrap this up with, right, Rick? Where it's not, yes, it's kind of some negative news, but because of that, you're going to have kind of positive things coming from it.
Yeah. Also, if you are finding a job, if you are not an entrepreneur but finding a job, you also think that way. Maybe based on personal situation, job safety, all that. But if you have the tolerance for risk, maybe you should look for, as Jack, you alluded to, maybe today is a small company, but if you build, you believe in certain future, then you should join early, right?
Right. Thanks for the advice, Eugene.
Excellent, Eugene. Thank you so much. This was great.
Yeah, good talking to you, Jack and Rick.